The current stock price for OpenDoor Technologies, Inc., traded under the ticker OPEN, is $7.70, reflecting an intraday movement of minus 1.03% as of 1 p.m. EST on November 28, 2025. That seemingly minor dip today is a crucial piece of the bigger picture, and it's actually the low borrow rate for short sellers that should concern long-term holders more than the daily price volatility. While the stock has seen a spectacular run from its 52-week low of around 50 cents, giving the illusion that the company has fundamentally fixed its business model, the real deep-seated issue remains the relative ease with which bearish bets can still be placed, and that's an insight most retail investors are missing, caught up instead in the thrill of the bounce. The common expectation surrounding OpenDoor is that it's finally finding its footing in a volatile housing market, demonstrating that its core iBuying model, instant buying and selling of homes facilitated by proprietary software, can be profitable or at least break even under the right conditions. This expectation is fueled by the recent narrative of OpenDoor 2.0, which promises greater financial discipline, a focus on margins over volume, and utilizing their technology advantage more effectively. The spectacular stock appreciation from late last year certainly reinforced this belief, making it look like the worst of the housing market's volatility, which hammered their balance sheet, is now behind them. However, the reality is far more complex, and a single-digit borrow fee for shorting, currently sitting at a remarkably low figure around 0.39% annually, according to recent data, suggests that large institutions do not see an immediate, catastrophic risk to their short positions. They are not being squeezed out by prohibitive borrowing costs, which is a key component of a true, sustained market turnaround. Looking at the recent trading activity, the daily volume today is high, sitting at over 55 million shares traded, a figure that is notable even if it is below the 3-month average. High volume on a slight down day, following a period of massive gains, suggests either institutional profit-taking after the most recent earnings-fueled spike or a concerted effort by short sellers to cap the price. Institutional activity has been mixed. While some funds have rotated out, others, particularly those focused on growth or technology-enabled real estate, have increased their positions, suggesting an internal debate on Wall Street about whether the company can truly decouple its performance from the macroeconomic housing cycle. The reaction to the last earnings report, which highlighted a narrower net loss and a positive adjusted EBITDA in a challenging quarter, was overwhelmingly positive, sending the stock surging. The market chose to focus on the improvement in execution and the reduced inventory risk rather than the continued gap losses, demonstrating the powerful role narrative plays in this stock. What OpenDoor does, at its core, is act as a market maker for residential real estate. Instead of the traditional 60 to 90-day selling process involving agents and open houses, OpenDoor offers a near-instant, data-driven cash offer to sellers. They take on the risk, manage the light repairs, and then resell the home on their platform. Their profitability hinges entirely on their pricing algorithm's accuracy, buying low enough and selling fast enough to cover holding costs, repair costs, and their service fee, all while managing the risk of market depreciation during their holding period. This model thrived during the pandemic-era housing frenzy when prices were rocketing and holding risk was minimal. It was nearly destroyed when interest rates soared, freezing transaction volume and forcing them to sell inventory at steep losses. This is the central conflict for investors. Can the technology truly master the market, or is the business model inherently vulnerable to interest rate cycles and regional housing bubbles? The current forward outlook for the company is tightly coupled with the Federal Reserve's stance on interest rates. The market is projecting rate cuts, which would reduce mortgage rates, unlock inventory, and spur transaction volume, all massive tailwinds for OpenDoor's iBuying model. If the Federal Reserve shifts its language, or if inflation proves stickier than expected, prompting a higher-for-longer rate environment, the expectation that Opendoor is on the clear path to profitability will clash violently with the reality of suppressed home sales and elevated carrying costs. The company's recent move to prioritize a lower volume, higher margin strategy is a tactical necessity, but it simultaneously sacrifices the scale advantage they need to truly dominate the market, leaving them in a tricky middle ground. Now, let's address the short-selling awareness and pressure, which is a critical piece of the Opendoor narrative. This stock has been a notorious battleground for years. The reported short interest is significant, currently sitting at approximately 127 million shares, which represents about 16.28% of the float. That's a high concentration, indicating strong conviction from the bears. The most recent days to cover figure, a measure of how many days short sellers would take to cover their positions based on average trading volume, is sitting at around 1.44 days. A number below 3 is generally considered low, suggesting that while the absolute number of shorted shares is large, the liquidity is currently high enough that short covering might not cause an immediate parabolic short squeeze. This is precisely why the low borrow rate is so revealing. Major short firms like Citron Research and others, who have publicly criticized the iBuying model's structural vulnerability, have had an easy time maintaining their positions. Their thesis is simple. The current high interest rate environment fundamentally breaks the quick turnaround, low margin model. And even with better execution, the gross margins are too thin to consistently cover substantial operating expenses. For retail investors tracking this, the actionable insight is to monitor the fail-to-deliver data and the short borrow fee rate. The recent borrow rate being under 0.5% is a green light for bears. If you see that rate spike dramatically above 5% or even 10%, it signals that available shares to short are drying up and the cost of maintaining a short position is becoming prohibitive, which is a prerequisite for a legitimate short squeeze. Furthermore, tracking the option open interest is key. High open interest in far out-of-the-money call options can signal speculative retail bets anticipating a squeeze, while high put open interest at near-the-money strikes suggests institutional hedging or bearish positioning. What's your take on the rising short interest, smart money, or manipulation pushing fear? The internal debates on Reddit and X, Twitter, are focused on the meme stock potential of Opendoor, tying its high short interest to the possibility of a coordinated retail buying event. While that dynamic is a factor, it's critical for individual investors to understand that coordinating a squeeze against multi-billion-dollar hedge funds is exceptionally risky. The recent significant fails-to-deliver figures from mid-November, where millions of shares failed to settle, are a temporary curiosity, not a sustained signal of market failure, and they quickly dropped off. They represent localized liquidity issues, not a company-ending coordinated short attack. Retail investors should focus on the fundamentals, the company's ability to turn a consistent GAAP profit, which has so far been elusive. Look at the balance sheet. While the inventory is decreasing, the health of their remaining inventory, how quickly they can cycle it, is paramount. The next earnings report will be the true test of Opendoor 2.0, showing whether the company can maintain higher gross margins and keep operating expenses contained, especially as inventory volume slows down. The future outlook for Opendoor is binary, a classic expectation versus reality situation. The expectation is that they will be the Amazon of housing, a highly efficient, scalable platform that uses technology to disintermediate the old guard. The reality is that residential housing is geographically fragmented, incredibly capital-intensive, and inherently illiquid compared to other goods. Opendoor has a massive opportunity if they can truly pivot their platform to a software-as-a-service model for home financing, title, and escrow services, essentially monetizing the transaction process for other investors rather than relying solely on the iBuying spread. This pivot to higher margin ancillary services is what could truly change the long-term reality of the stock, but execution risk is high. For now, the stock remains a high beta trade, a magnified play on the housing market and interest rate expectations. The price has run up based on the expectation of future profitability in an anticipated lower rate environment, but the current low-cost short interest signals that the smart money is highly skeptical that this profitability is sustainable without those macro tailwinds. The ultimate catalyst will be a confirmed shift in interest rate policy or a demonstrated back-to-back quarter of gap profitability. Until then, the stock will continue to swing wildly on housing data prints and short-term liquidity events. We need to see that days to cover number rise significantly or the borrow fee spike to truly believe the short pressure is waning. Comment below how many shares of OPENDOOR technology